Hi, good morning. Welcome to Morning Kappa. Here we come to the week 2 of August with futures. Okay, before we begin, as usual, I would like to highlight a brief disclaimer. Trading in futures and options involve a high level of risk due to leverage and may not be suitable for all investors. This presentation is intended for educational and informational purposes only and does not consist an invitation or recommendation to buy or sell any financial instrument. Please consult your licensed broker or financial advisor before making any trading decision. The global market this week reflects a solid structural momentum across Western growth equities, while regional Asian benchmark and agricultural markets undergo selective consolidation. Wall Street tech-heavy benchmark have confirmed their rebound, maintaining strong alignment across both short-term and long-term view. For local products, FKLI is from positive last week into neutral stand this week. Consolidation near recent high alongside an overall neutral macro trend. FCPO remained the sole positive outlier in an agriculture complex, posting back-to-back positive weekly outlook for both weeks despite its underlying neutral overall trend. In Asia, both the Hang Seng Index and China A50 remain neutral in short-term view as investors await fresh policy signals. In the U.S. market, the Dow Jones, Nasdaq, S&P 500 continue to demonstrate strong structural resilience, holding back-to-back positive outlook since last week. Robust corporate earnings, broad market participation beyond mega cap tech, and resilient economic growth are sustaining buying momentum. In the grain complex, corn surrendered its week 1 positive momentum, reverting to neutral this week, alongside soybean and soybean oil, as harvest expectation and crop inventory data kept immediate upside. For metal, copper maintained its dominant strike, posting consecutive positive weekly profile in both weeks, supported by strong industrial demand and tight physical inventories. Gold and silver enjoyed a bullish run last week, but have since shifted to neutral this week, expecting a correction. In energy, crude oil remained in neutral while preserving its long-term positive support again. And as for gold, gold rose for a third straight session on Tuesday, hitting a more than 2 months high at the 4495 level, despite rising inflationary risk and expectation of interest rate hikes driven by surging oil prices. China's central bank also accelerated its gold purchases last month, with reserve increasing by about 20 tons in July following an addition of around 15 tons in June. This marked the largest monthly increase since October 2023 and was one of the key factors pushing gold prices up by roughly 8% in a week. Meanwhile, uncertainty persists over a potential deal between the US and Iran to end the conflict and to reopen the Strait of Hormuz. And traders now are turning into their attention to the latest US inflation data this week for signal on the interest rate outlook. The red box here illustrates gold's performance since our meeting last Wednesday on Morning Kappa. The market has broken out of its consolidation phase, with prices recently testing the 4495 resistance level. It's crucial to see if WTI prices is able to stabilize above 4430. The next resistance to monitor is 4530. Any failure to support above 4430, we shall expect a market pullback to 4210 before the next move. WTI crude oil futures rallied sharply, rising around 8% at the beginning of this week. The lack of an agreement between Iran and Oman to reopen Strait of Hormuz is limiting crude supplies from the Middle East and boosting oil prices. An attack on a Saudi oil refinery has further strained global fuel supplies, pushing energy prices higher. The risk of renewed conflict across the Middle East remain elevated as another UAE tanker was targeted by a missile on Saturday while transitioning the Strait of Hormuz. And furthermore, Ukraine has attacked Russia refinery, oil tanker, and major pipelines infrastructure at least 30 times in July, the second highest monthly numbers of strikes since the war began in 2022. These developments have tightened global crude supplies and added upwards pressure on oil prices. The red box highlights crude oil performance since last Wednesday on Morning Kappa. Prices rebounded from 74.3 to USD 84.64. The oil prices then experienced some pullback. 79.42 will be the crucial point to watch out. Any support above 79.42 will likely to see another rebound of upside to 86.52. If the prices fail to support above 79.42, market likely to retrace back to 76.74. Well, before we look ahead, let's recap the market guide over recent weeks. There is one close with a realized profit and two remain in position. We initiated Micro's silver guide on 22nd of July and successfully hit our potential profit of USD 4,375. Our FKLI guide is still in position with reference price at 1710 and the current market price now is 1736.5. We have shifted the stop level to 1710 since the second target is achieved. The FCPO is also in position with reference price at 4630 and the market price now is 4717. The stop level also moved to 4630 as the first target is achieved. As usual, the highlight of our briefing, the future market call, we are anticipating a potential opportunity in micro WTI crude oil for September month. The initial investment is USD 834.90. The short-term chart setup is positive. The reference price is 78.5. Potential profit price is 82 and 86.5, targeting a gain of USD 350 or 800. The potential stop loss price is 77, capping the potential loss at USD 150. The risk and reward ratio is 1 to 2.5 to 5.3. We also anticipated a potential opportunity in micro copper for December contract. This is a swing trade, therefore we are looking at a further month. The initial investment is USD 1,320. Short-term chart setup is positive. Reference price is 6.54. Potential profit price is 7 or 7.455. Targeting a potential gain of 1,150 and 2,287. Potential stop loss price is below 6.3, capping a potential loss of USD 600. The risk and reward ratio is 1 to 1.9 to 3.8 times. We are pleased to announce the launch of our exclusive initiative, the AM/PM Market Guide, which has been launched since June, strategically designed to assist you in navigating crude palm oil intraday movement. This service provides 2 daily market calls, one in the morning, one in the afternoon. Please note that all trades are strictly intraday with no over-session position. This premium features is reserved exclusively for our RHB client only, and we invite you to contact our dealer, our reminder, for further information on how to access these insights. And if you are completely new to futures, we have our new campaign called Zero Brokerage Bonanza to start your journey in futures trading with zero brokerage up to 1,000 from 1st of August to 30th of September. Reach out to us or drop us an inquiry on the RHB Invest website today. And not only that, every trade you place will also qualify you for trade and win lucky draw entries, giving you chances to win a Tesla or take away a monthly prices of iPhone 17. So start trading now and tap on our exclusive AM/PM market guide. Well, that's all from me today. Thank you for your time, and I will hand over to the next speaker. Thank you. I'll see you next week.
Okay, all right. Morning, everyone. Welcome back to Morning Kappa at 8. Thank you, Megan, on the weekly futures update. So, looking at the Hang Seng Index, yesterday there was a mild profit taking, but as we know, right now this morning, the oil price continue to move higher, right? And the market is have a concern on the supply on the crude recently. So, as for the Hong Kong market, firstly, we look at the CNOOC stock code 883. Counter as a break past 24 Hong Kong dollar, moving towards 25 and followed by 26. Downside support is 23 Hong Kong dollar. Then on we have a tech stocks, AAC Technologies, supplier to the iPhone as well. Break past the 42 Hong Kong dollar, moving towards 44 and followed by 46. Downside support is 40 Hong Kong dollar. So we have two Hong Kong breakout stock this morning, CNOOC, oil and gas related counter, followed by the AAC Technologies. So looking at the China A50 overall technical setup remains bullish, right? We can see that the support level is at the 20 days moving average, but the band will be at 15,300 towards 14,400 right now. As for the A shares, firstly we look at this counter stock code 600 667, and you can see that the stock have built quite a strong base near 1750. So as long as I stay above the breakout point of 20 renminbi, this counter 600 667 will climb towards 2250 and followed by 25 renminbi. So the stock name is called Wuxi Taiji Industry, right? The code is 600 667, which you can actually find in our RHB trading platform. Okay, and looking at the S&P 500, the counter was undergoing consolidations after last two trading sessions. Market have a concern on the oil price that actually moving up above $82 per barrel. We still keep a bearish bias on the crude oil, right, until the crude oil break past the 86 resistance. So this 86 resistance is where the crude oil have fell below when the Trump have suggested that it's going to have a peace talk with the Iran. But right now, you can see that the negotiations have come to a stalemate, and there's no much information whether the oil is actually flowing out from the Hormuz Straits. Despite that, the S&P 500 continue to see a bullish sentiment on the tech stocks, lifted by Microsoft, right, Nvidia, as well as the Google, right, and looking at one of the US stocks that we have mentioned yesterday, which is the ABNB, right? Yesterday night, the ABNB continue to show a bullish sell-up. Sentiment remains strong so far, and the stock are staying above 180, moving towards 190 and followed by 200 US dollar, right? And as for the FKLI, we still keep a bullish bias, but likelihood the FKLI is going to move higher this morning. Later on, Leng is going to share on one of the CI related counter SDG, and Siang will talk about the Mr. DIY. Now, as for the these 2 months, July and August, generally you look at the August month, this is where Malaysia we have our quarter result period. In the past, likelihood the CI will have a positive record in the month of August. So I think that in light of good results, I still see that the CI will have a positive price action this month. Likelihood the FKLI will be testing 1760. So on the downside, we keep our stop loss point at 1680. Meanwhile, for the FCBO, I continue to move on higher high, heading towards 4009 level. So yesterday we have mentioned two stocks, which is DNEX and VS. This morning I just highlight one Sarawak related counter, which is MTT SL, MTT Shipping and Logistic. Share have break past 1 ring and 13 cents, heading towards 1 ring and 18, and followed by 1 ring and 23 cents. Now, secondly, the SCG Southern Cable Group continue to garner market attention, breaking past 260 and moving upwards. Right. The other tech stocks that under our watch list, which have a strong breakout on the Monday session, was Skychip. It have crossed above 3 ringgit and 30 cents, 20 cents, and right now moving toward 3 ringgit 40 and followed by 3 ringgit 60 cents. Skychip is due to report their earnings soon, and towards next Saturday, Skychip is going to have a physical briefing sessions with our EQT team, Vanessa, at the UEM tower. So do look out for Vanessa to register the event, to have in-person sessions with Skychip next weekend. Right, and this morning, Aiman have wrote two trading idea. Firstly, Guan Chong GCB, that you see the GCB have break past 1 ring and 25 cents, heading towards 1 ring and 30, and followed by 1 ring and 35. Downside support is 1 ring and 20 cents. Secondly, we have another tech stocks, SAM Engineering, cross above 4 ring and 55, heading towards 480, and followed by 5 ring and 5 cents. Downside support is 4 ring and 30 cents. So we have two breakout stocks this morning, Guan Chong, GCB, and followed by SAM Engineering. So I'll stop here and pass on to Li Ling on the SDG report. Thank you.
Yeah, hi, thank you, Joseph. Good morning, everyone. So we've got SDG results that came out yesterday. So just a quick note about what's happening there. So results came in actually above expectations, with the first half numbers coming in at 64 to 67% of our and consensus FY 2026 forecast. And this really came from the higher than expected profit from its industrial development division, where they recorded 689 million ringgit in EBIT in the first half of 2026 versus our 500 million EBIT target. They also declared an interim DPS of 11.18 cents, which implies a 50% payout ratio. So in the second quarter, SDG recorded a land sale gain of 529 million, and that's coming from the sale of 935 acres of land in Kulai. For the second half of the year, they should recognize at least one, if not two more land sales, 170 acres in Kluang and 1,022 acres in Bukit Kerayong. So with that, we think that our land sale assumption of 500 million is a bit too low. So we've raised it now to 700 million for FY 2026, but keeping to our 500 million estimate for FY 2027 to 2028. If you look at CPO, they recognize an ASP of 4,209 ringgit in the first half of the year. And for second half, they have sold forward 76% of their Malaysian output at 4,400 ringgit per ton or thereabouts. But for 2027, they've actually dialed back on forward sales to minimal levels, where they're expecting prices to cross 5,000 ringgit per ton in the first quarter of 2027. So Indonesia and Papua New Guinea, if you note, is still continues to be sold on spot rate terms. In terms of FFB output, they recorded a strong recovery in the second quarter in terms of FFB, where output increased by 20% quarter on quarter, and that brought first half 2026 FFB output growth to minus 2%. This is slightly below our 2% year-on-year estimate for FY 2026. And also management's guidance of low to mid single digits, but they are still keeping to that growth guidance for the year because they do still expect the second half to continue seeing the normal peak production period, that they will normally see, and they're only expecting the impact of El Nino to start being seen towards the year end of 2026 and beginning of first quarter 2027. So they've noted that in previous El Ninos, yields fell by between 10 to 15%, and particularly for areas
in Malaysia like in Sabah, and in Indonesia like in Kalimantan. So we're keeping our growth forecast for now, which is still 1 to 3% for FY 2026 to 2028. In terms of unit cost, SDG's blended unit cost fell 3% year on year to 2,516 ringgit in the first half of the year. They have applied about 40 to 50% of their annual fertilizer requirements for the first half. And if we to assume they are able to catch up the rest in the second half, then we could see overall fertilizer costs to be higher, about 30% half on half. But for the full year, this will even out to be around about 8% higher year on year. Nevertheless, they're still keeping to their 2,700 ringgit per ton cost guidance for the year, where they're expecting, the second half to be higher cost than the first half. In terms of downstreams margins, they actually saw an improvement in the second quarter, where the downstream margin rose to 3.1% in second quarter from 2.6% last quarter. And this really came from the trading and bulk segments, which generally tend to do better in a volatile environment. And given that it is still volatile, the current environment, they expect to continue doing pretty well for their trading and bulk segments. The differentiated segment, however, is still facing weak volumes and margins, especially since the European customers continue to buy on a hand-to-mouth basis. So overall, we have upped our earnings forecast by 13.8, 12.2, and 9.5% for FY 26 to 28. And that's after imputing our latest CPO price assumptions of 4,005 for 2027 and 4,004 for 2028, both from 4,300 previously. We've also imputed in higher land sales, as mentioned, and also updated for our latest in-house forex assumptions. So with that, our target price is now up to 8 ringgit from 7 ringgit. And this also includes a revised 6% ESG premium, as we've also raised our ESG score to 3.3 from 3.2. So we continue to like SDG for their monetization and diversification strategies. We do expect earnings to continue to pick up in the second half from stronger output and higher prices. Valuations still look attractive, trading at 18 times 2027 PE versus the peers of 17 to 20 times. So let me stop here and pass on to our next speaker, Siang. Thank you very much.
Okay, thanks, Leng. Morning, everyone. I will continue with a results note on Mr. DIY. Similarly, this is their first half 26 results. Essentially, net profit of 326 million, which was down 2% year on year, was below expectation, having only accounted for 46 to 47% of our consensus forecast. I think this is mainly due to the softer than expected sales traction, and there was also a couple of factors leading to higher than expected OPEX. If we look at numbers cumulatively in first half, revenue grew 7% to 2.6 billion. This is primarily underpinned by new store addition of 108 new outlets, or 7% additional from the base last year. Same-store sales growth was recorded at -1% for first half. It was -3.7% in the second quarter. So I think in terms of the sales momentum, it looks quite weak in the second quarter, and that has obviously led to quite a bit of negative operating leverage. Meanwhile, if we look at the gross margin on a first half basis, it was up 0.2 percentage point to 48%. That's very much due to the favorable forex and increasing scale of operations. And as mentioned, there was a couple of factors leading to an OPEX jump of 11%, which has outpaced the outline growth by quite significantly. Firstly, the depreciation charges for its automated warehouse, which started in July 2025, SSD on rental effective January 2026, and the more temporary cost items will be the additional wages to support the upgrade of automated warehouse, which was closed to facilitate the upgrade. And there was also an under provision of CSR expenses, which caused more CSR charges to be booked in the second quarter. So that has led to a 2% year-on-year decline in first half 26 net profit. And on a Q-on-Q basis, due to the weaker seasonality, we saw both sales and net profit dipping quite materially. And on top of that, I think we also saw gross margin taking a hit in the second quarter to support their price promotion campaigns. Having said all that, the dividend payout has surged to 4.9 cent in the first half, much higher than the 2.9 cent declared for the same period last year. This will imply a 142% payout ratio. So this is, I think, quite a positive surprise for a lot of people. So post results, we cut our earnings by 3 to 4% to factor in the softer sales traction and higher than expected OPEX. Essentially, we expect second half earnings to catch up on receding cost pressures coming from this cross margin front, and OPEX should also moderate with the some of the temporary cost item to expire. And consumer sentiment should recover gradually from the low in second quarter, given the improvement in the overall situation of the Middle East geopolitical tension. On top of that, we believe a more supportive than ever budget 2027 could spur investor interest on Mr. DIY, considering its attractive valuation versus peers, on top of the rewarding dividend yield and expanding ROE. So all in, maintained buy on Mr. DIY. Our target price is now 2 ringgit and 3 cents. Let me stop here, and I guess this is all from us for today. Thank you so much for joining us. Happy trading, and we will see you at the next morning kappa at 8. Thank you.